you're about to buy a rental property, what are the different structures and what should you think about with those structures?
When you're buying a rental property, people normally think that just buying it under their personal names is the best option, but it may not necessarily be the best option for you, depending on what tax bracket you are on, where you are at your life with. So there are different structures you can think of before buying the rental property. And it's always good to consult the accountant or the lawyer to discuss the structures. So you could either have it under the company or under a trust, or maybe it may just be suitable to have it under your personal names. Now, if you decide to have the rental property under the trust, the tax is going to be 39% flat on the trust income, which means if the rental property makes any income, and if you leave that profits under the trust will be taxed at 39%. But if you do allocate it to the beneficiaries, then the beneficiaries are taxed at their marginal tax rate. Trust is normally good from an asset protection point of view because that really gives you the ability to protect your assets as compared to having the property under your personal names. Most of the people, I guess, in New Zealand go with the trust structure from protection point of view rather than the tax benefit. So that's one structure you can follow when you are looking at buying a rental property. The other one is a company. It can be a normal company. You open the company with company's office. Now, company also comes in two types, LTC or a normal trading company. LTC is considered as a look-through company where basically it's just a shell. You both, the person who owns the rental property is the owner of the company, and you cannot leave any profits in the LTC. Everything has to be allocated to the owners. That is one structure of the company. The other one is a normal company, trading company, where you can own the rental properties under the company. If there are any profits, the company can retain the profits and the company will be taxed at 28%. It's good if you are on a higher tax bracket, and if you have got multiple properties, you can have a portfolio of properties just under the company. The third structure is having the rental properties under your personal names. And I guess I have seen that as the most common structure when someone is buying their first rental. They just go ahead, buy the rental, don't consult anyone, have the properties, husband and wife, under their own names, 50-50. Any profit gets divided 50-50 between both of them, and that gets taxed based on their personal marginal tax rate. So these are the three structures you need to think of before you even sign the documents with the solicitors as to what structure you are going to go with for your rental properties.
Yeah, in terms of the trust thing, when you say protection, is that really from creditors? And then provided you don't have any personal guarantees of the loan, or like, how do you ensure that protection is actually any good? You know, because I've heard a lot of people breaking trust.
See, yes, from creditors, definitely. But if the Crown makes, a case against you or something, your trust is not protected from the Crown. It will be protected from creditors, definitely. If you are going through pass on that property to your kids, or if you are going to, in future, going to go through a breakup or something, trust will definitely help you to a certain extent if you have formed the trust in the right way with the lawyers. The lawyers normally form the trust, not us, the accountants. If the lawyer has formed this trust in the right way, that certainly will give you certain protections. Coming back to your question of personal guarantees, when you are signing the loan for the rental property, the banks normally make you sign personal guarantees. So there are interlocking guarantees attached between you and the trust, which means tomorrow if you don't pay the bank loan, the banks can come behind you. So banks protect themselves with personal guarantees.
Interesting. So then, even though you got your trust, you've made a personal guarantee. So then, the protections from the trust. Is there a way to get a loan without a personal guarantee? I know this is a tax question,
No,
so we'll move
no,
on.
no, you can't do that. The banks do make you sign personal guarantees. Yeah.
Jeez. Yeah. I mean, the trust to me, like, because the relationship property, if it's run well and it's treated as separate property, it's tricky. Like, I've seen that broken a lot. The creditors hasn't. There was a precedent. I can't remember when where they can find a way through.
Yeah. Yeah. To be honest, trust, based on the size of the country, we have got so many trusts in New Zealand. And many years back, it was a barbecue discussion, you're sitting and having barbecue with your friends. Someone says that I've got a trust. The other person goes and, opens the trust, not knowing how it works and what it is. So we have got so many trusts in New Zealand, which now most of the people don't even know how it works and what it is. Recently, a couple of years back, there have been changes to the trust. And that has made people realize whether I should be having my, properties or affairs under the trust or not. And people are seeking legal advice on this. A lot of people have wind down on their trust. They have closed their trust. And, because that was just not the right structure for them.
Yeah, it's definitely worth thinking about.
Yeah. It's very important to get legal advice before getting trust rather than just opening a trust because your friend has a trust.
Yeah.
It may suit his purpose, but not yours. So you don't know.
Yeah, no, well said. And I mean, the administration and having the professional trustee and setting up all the like, it's a minefield. But I didn't quite get the company part thing, though. So you got this shell of a company, look-through company, and then you have to pay yourself profits. What is even the point of it? Like, is there any benefit to having a look-through company? I've heard it a lot. Like people,
Yeah.
like,
me personally, I don't see any benefit of having a look-through company. That's again just my personal views. So in 2008, 2010 maybe, it used to be LAQC, Loss Acquiring Company, Qualifying Company, where as per the old tax rules, if your rental property has made a loss, you were able to offset those losses against your personal income. So when it was an LAQC, there were definitely more benefits of having an LAQC. A lot of people had their properties under LAQC. And then when the LAQC was, established, IRD gave an option to people. Either you transfer to an LTC, which is a look-through company, and that was an automatic transition to an LTC. So a lot of people just followed through with an LTC after an LAQC. And now, obviously, with the changes of the tax rules, you cannot offset the losses of the rental properties under your personal names, which means if you have an LTC, that benefit no longer exists of transferring the losses. You could still do that under your personal names. It's not that you couldn't. But now those losses are ring-fenced. So obviously, if you have an LTC, which is, going on for years, you don't want to change that now, because if you do change that now to a normal company or to another structure, the bright line rule starts from the day you change it.
Okay, wait, before you go down that route, so ring fence, I've heard that a lot. Why are you putting fences around things? What's this? What does that mean? What's a ring fence?
So ring fence means, let's say your rental property has made a loss of $5,000, right? Earlier, you were able to offset that $5,000 loss against your personal income. So if your income from PAYE and other sources, for example, was 50,000, you were taxed on 50, you get $5,000 from loss from the rental property. That could offset your personal income. which means your income now becomes 45,000. You have paid tax based on 50,000. However, after the loss, it comes to 45, which means you get a refund from IRD. So the old government changed the rules, which means that $5,000 loss cannot be offset against your personal income or any other source of income. That 5,000 loss is going to carry forward until your property makes a profit, and then you can deduct this loss from the profit. So that is what it's called, ring fenced.
Ah, okay. Yeah, they love their stupid words there. I'm going to remix all these words. Okay, so there's the look-through company maybe don't change, but it doesn't really make sense in your eyes. The company part, like, so what's the point of putting it in a company? It's just easier. You like to call it names or something, or why would you use the company?
So I guess if you have, let's say if you are on a 39%, tax bracket, and you have got multiple properties, you want to keep them separate, the portfolio, you can have the properties under the company where the company will be taxed. If we leave the profits in the company will be taxed at 28%. So you are saving that 11% on there. Now, recently, and don't quote me on this because it's not confirmed yet, but let's say if you do decide to move to Australia, you can actually elect for the company to be a New Zealand resident company, which means you file the taxes of your rentals here in New Zealand, pay the taxes in New Zealand, and you don't have to report those tax returns there. So that also is going to be now so many people moving to Australia, with changes of their job and everything, that could be beneficial to them. And
Yeah.
also from the tax point of view, as
Cool. And randomly the internet might not do too well and go slow, but we just keep talking because it records it locally, just in case you notice a lag there. So you started mentioning the bright line, like, there's a line that's really bright and it has something to do with, your losses. And like, I get the bright line test. I don't know why it's not capital gains, but anyways, what is this bright line test thing?
bright line is basically like a capital gain tax. So I'm not sure if you know, Ryan, a couple of years back, we are in 24. So I think 21, 22, um, a lot of hoo-ha went out about capital gain tax. We as accountants went a lot of training, on capital gain tax. The previous government said that they are going to introduce capital gain tax on residential property. And it was just at the end too complicated for the market. So we don't have capital gain tax in New Zealand. It is called a bright line test. Similar to this, but that's called a bright line test. Now, again, there have been so many changes on bright line test. When it was introduced in 2015, it was for 2 years. Then the rules changed again. Now, with the new government, the national government, which we have, they have changed the bright line rule again to 2 years, which means any property that is purchased after 1st of July 2024 will have a 2-year bright line test, which means, let's say I buy a property on 1st of July 2024. I sell it, a rental property. I sell that property on 1st of July 2025. So if I have bought the property in 24 for $1 million, and on 1st of July 2025, I sell that rental property for $2 million, right? I have made $1 million profit. I will be taxed on that profit. That is called bright line test because it falls within that 2-year period. So if purchased within 1 year, if I sell it, I'm taxed. But let's say I bought the property for $1 million on 1st of July 24 and I sell it on 1st of July 2030, which is 6 years down the line, and I sell it for $2 million, I've made $1 million profit. As per the bright line test, there's no tax because it falls outside that 2-year window.
Yeah, that's crazy. Yeah. You can
But
make,
again, in saying that, you could be taxed under the land tax, IRD can come behind you on land tax, which is for 10 years. Uh, if obviously your intention was always to resell. So bright line is basically a period. And as I said, every time I have seen a change of government, that keeps changing. So with the new government now, it's 2 years. If there is a change in, if you buy and sell within 2 years, and if you make a profit, you get taxed on that profit.
So why is this land tax? What's the point of having something that overrules the other thing? What is land tax?
Land tax is for 10 years. That's separate. That's again looks at the intention, what your intention was, and, the, at the time of the purchase. So that is a separate thing.
Okay, so bright line doesn't matter what your intention is. You just got to wait 2 years. And then the land tax is like, if you put in a compelling story about, oh, I didn't mean to sell, it was never my intention, sir, and prove it pretty good, then you might get away with it, but probably not.
You really have to show basically, why you're selling. So yes, what you said is right. If it's a genuine reason that you have sold the property and IRD comes behind you that you would be taxed under land tax, then you really got to show to them as to why you have sold.
Makes sense. I'm sure I can make a compelling story, like, my hamster died or something, and every time I look at their memory lives on in my eyes, and I have to sell it. It's haunted. So, okay. All right. So that's one. So now you're going to buy a rental property. What are sort of the things you should think about, like where people come unstuck? You mentioned like bank accounts and stuff.
I guess now again, this is quite important for people who are buying their first rental. Uh, you know, think of it as a business, to be honest. So have a separate bank account for your rental. All your income should be going into that bank account. All your expenses should be going out of that bank account. So your interest cost on the loan or your loan payments, your rates, insurance, repairs work, everything should go out of that account. And your rental income should be coming into that account. So that way you're not using your personal account for rental purposes. Tomorrow, when you give that information to the accountant, you only give that rental account information to the accountant. You don't give the whole personal account and make it messy. That's, I guess, is very important when you are looking at, setting up the rentals. The other thing what I have seen with people is we have to show the loan and the interest cost on each rental property separately. People just club all the loans under one suffix or under one loan. And then, it gets a bit messy as to which rental does the loan relates to and how much is the loan for each property. So it's quite important if you have got even one, let's say 1, 2, 3, n number of rental properties, you got to have a different loan for each property. So if you own property number 1, the loan suffix, let's say 91 should be for that property. If you own the second property, loan suffix 92 should be under that property, so that it becomes easier for us to report to IRD. The other thing which I have seen is from people is if they have got rentals under their personal name, they think that they don't have to report that income with IRD. You have to file your tax returns with IRD if you own rental properties. Because as I said, it's a business. You consider it as a business. Even if your property makes a loss, you still have to file the tax returns for the rental with IRD.
And how do you manage the cash flow? Like, do rental property people use Xero, or do they use something else? Like, how do you stay on top of things?
I personally, and I guess Xero may not like this, but I personally say to people, if you've got 1 or 2 rentals, Excel is good enough for you to see, what you have done. You Zero can be a costly affair for you if you don't want to invest on a software. You could certainly, keep tracking your income on Excel as to how much income you have received and how much you have paid on the rental property. One thing people don't understand is when it comes to expenses, it's only the interest cost that is considered as an expense, not the full loan payment. So if you're making a loan and a principal payment on the loan, the principal part of it is not your expense. That is reducing your liability. That should not be there as an expense for you, only the interest cost. Now, with the interest cost also, again, with the old government, it was a bit tricky. We were not allowed to claim 100% interest cost. So, like the first year was 100%, then it was 175, then it went to 75, then now 2024 was 50%. So people thought that if my interest cost is $10,000, that I will be able to claim all of that $10,000 as an expense. And I was like, no, we can't do that, because if it is 50, we can only claim $5,000 as an expense. But again, the rules are changing now again. So with the new government this year for 2025, we will be able to claim 80% of the interest cost as an expense. And then next year, we'll be back to normal 100%.
Can you claim everything else like that's related to the rental property? You get a builder in, you get a property manager. What else can you actually claim with the tax?
Property manager, yes, you can claim. The commission for the property manager can be claimed. Any repairs work on the property can be claimed. Your water charges, your insurance, all of that can be claimed. But if you're getting a builder to make any improvement on the property, that cannot be claimed as an expense. Again, I say this to all my clients. If you're going to have a major expense, give me a call first, because I don't want surprises at the end of the year, me saying to you that you can't claim and you have already incurred that as an expense. So if, let's say, you are adding another room, that is improvement to the property, you cannot say that there's a repair. If you are redoing the kitchen, that again is an improvement that's helping you get better rents. So any capital improvement you're doing to the property, that cannot be deducted as an expense. So obviously we look at it on a case-by-case basis as to what it is. Just to justify, to make sure that we do the right thing with IRD. And for us to justify that as an expense, we really have to see if there are big ticket items like redoing the bathroom or redoing the kitchen or the roofing or the painting can be classified as repair or is classified as capital in nature.
That makes sense. So is it kind of like an overarching view that, like, if it impacts your income in some way, then potentially it could get claimed, but if it's going to capitally appreciate the property, then you probably couldn't.
Yeah. I guess the best example is the roofing. And it's quite funny how IRD has got that interpreted, which people don't understand sometimes. So if your roof is leaking, if it's a gradual, damage, or let's say if you need to fix your roof, you fix your roof with the same material. If there is a damage, then it can be classed as repairs. But if you're using a different material, then it can be classed as capital in nature, which means you can't claim. So little things, we really got to see as to what you are doing and how you are doing and why you are doing it, whether we can claim that as an expense or not.
Makes sense. Is there like best practice? Like obviously management reports probably don't make much sense, but like if you could say to all your clients, do all these things exactly like this, and then this is really good and it'll make my life better and your life better, what would be best practice?
No, I don't say that because the rules keep changing so much. I don't want to give and have a blanket approach. for, everything. So the best thing I say to them, as I said, is if you have any big ticket items, call me first, because I need to know whether we can claim it or not. And you need to know whether you can claim it or not, rather than we sitting down at the end of the year and having a conversation that I can't let you claim this, right? It's best for you to give me a call and we go through things.
Makes sense. And I'll be curious about the numbers because, like, I hate debt. Like, and it's from being a financial planner and hearing all the stories of rental property. I remember in 2007 when I almost lost everything, but I made it. Now I'm rich. I'm like, it's a business, and it needs to be run well. And people can get in strife and make mistakes, but they can also leapfrog their financial freedom and do really well. So, what is it really like? You've got all the numbers. Like, how much are people actually making, and how hard is it really? You know what I mean?
See, I personally hate debt, right? But debt can be a good debt or a bad debt, depending on how you're investing, right? And where you're investing. So obviously, if you have taken a loan from a bank to buy, again, don't get me wrong, but if you have taken a loan from a bank to buy a very flash car, right? That's not a good debt because your car is depreciating in value. By the time you sell that car, you're not going to be left with enough money. Property, always, I look at it as a long-term game. You could either buy a cash flow. It is now getting difficult, to be honest, to get that cash flow gains on the property. Some properties are really good, but mainly you're looking at from a capital, point of view. So investing in a property, obviously, where you are investing, what you are doing, if you have done your due diligence correctly, that definitely does help you long term. You may have to put money from your pocket. It could be a short term, loss, I would say, for you, where initially you are putting money from your pocket, but it can give you good returns long term.
And how much money are they making, like income? You know what I mean? Like they buy a property, it's this, and are they balling like everyone thinks, or are they making like 10 grand a year and then they're barely surviving, like, but then they retire happily? Like, what are people actually making? Do you know?
So, to be honest, Ryan, in the past couple of years, as I said, properties have been a bit of either negative gearing, which means you're not making any cash flow out of it, or you're making very little. It used to be, good 5% returns earlier. But now, obviously, with all these changes and inflation and whatnot, it's not giving you that great return at the moment. I'm talking about residential properties. Some good commercial properties are still giving you 5 to 6% return on your investment. So
is that income or is that capital appreciation? What do you mean by five?
I'm talking about the income.
Okay, after tax and fees and everything, you get five.
No,
you're working
that's before tax. I'm talking about before tax.
What about in the pocket? What do you get? 2%?
You would say maybe around 4%, depending on what, but I'm talking about good commercial properties. I'm not talking about residential. But again, with residential also, Auckland has become very expensive now. So if you are investing outside Auckland, and I know a couple of people have invested outside Auckland, not a couple, quite a few, and the returns have been really good as compared to, So you just have to see what you can borrow from the bank, where you are buying, what kind of property you are buying. You have to weigh all that and look at it and do the numbers for yourself. So it may not be, as I said, in the short term, it may not be from cash flow point of view, but definitely it could help you in a long term when you retire.
Yeah, I get that. I mean, the main benefit is you don't have $1 million. Now you have $1 million and it's growing.
You're leveraging on the bank's money.
Yeah. which I get. I mean, the people that buy houses, I'm like, you're a psychopath. Like lifestyle, if you want to buy that because you want to have a dog and a family, mum always tries to say to me, "Oh, it's an investment, right?" I'm like, no, it's a well of where all your money disappears that you can't take out because you're going to buy in the same market unless you move to Otahu. So it's just being enslaved to debt for 30 years. But let's maybe not rush into it. But so what have you got to,
Have a chat on this offline.
well, lifestyle assets, like that. I get it. It's beautiful. You have an amazing life. Rental property, if you run it really effectively, you can be very successful.
Yeah.
Everyone just thinking it's passive. Like they've lost their mind. Like, what do you mean passive? Just sitting there trying to get tenants, trying to pick a property manager, trying to fix things, spending your weekends doing stuff, being cash flow negative for years. Out of curiosity, so how does it average out? I didn't quite get it. You said commercial, residential. You have some years where it's negative cash flow, some years where you're getting 2% with debt or 4%. What does it actually average out like where people with their cash flow? Are they with residential?
Depends. Again, as I said, your residential is always, I mean, me personally, I look at it as a long term rather than, a short term gain. With obviously, depending on how much loan you have, if you keep it on interest only, or if you're leaving it on interest and principal, the obviously variables to it, right? If your loan, people who have paid off their loan and, have had investments for a long time, obviously their returns will be higher. But if someone has kept the loan on interest only for past 10, 15, 20 years, depending on what the government is doing with the changes in the rules, your returns could be different. So I'm sorry, but I can't tell you what would be the average because it depends on, what you are and where you are at.
That's fair. If you're debt free and everything's like, is there any like examples? You can just speak from personal experience or just a client without saying their name. They're making this, they've got this.
I mean, obviously, if you are debt free, you've got no loan. So, and your expenses are not huge, right? Because how much is going to be your rates, insurance, agent cost, and little bit of repairs here and there. So if let's say, for example, if your rental is around 40,000, let's say deduct 10,000 worth of your expenses, you're still making 30,000 a year.
Gotcha.
If you
Okay,
don't have a
so
loan.
it's like a good
Yeah,
rule of thumb.
as compared to someone who's got a loan and they have taken 100% or, they have leveraged on the existing property and borrowed against the new property and the interest cost is around $30,000, they may not be left with any money.
Gotcha. Okay. So it's good because you're leveraging money you don't have under the expectation that it's going to grow over time, and then you can sell it when you retire or keep it running while you retire and live off the income. Is that kind of
That's right.
yeah, it's a business. People like do it with your eyes open for sure.
Yeah.
Like I
Yeah.
just like people don't have their eyes open. I don't know. How many of your clients have had a really tough moment with their rental property, like a percentage, if you had to guess?
I would say only total. I mean, yes, with the changes of the rules, a lot of people were hit by it, no doubt about it. But other than that, having bad tenants and all those bad experiences, only I would say 1% of it. One
Like
to two.
where it's financially tough and they're just worrying how they're going to pay the
Financially was
bills.
tough for a lot of people.
Oh yeah,
Financially was tough in the past couple of years for a lot of people. Due to COVID and, due to other reasons, changes of the rules and whatnot. But that is still fine. If you do have got a bad tenant, that really puts you in a difficult situation.
yeah. Can
So
we play that out quickly? Like what the bad things are, as well. Because obviously you can make money, you run it well, but like so you get a bad tenant, the income is down for a few months, or you have to go to a tribunal or whatever. Like what's the reality?
I guess for one person, the tenant didn't pay for was it four months roughly? obviously they had to go through, tribunal and whatnot and da. Uh, for one person, the tenants literally ripped off the carpet and the property. When they left, the property was not in a livable state. They had to do a lot of work in the property, which could have been avoided by having a property manager, I guess, if they did had a property manager at that time. So there have been various, obviously, cases where people have, regretted having rental properties.
What about money? Like what is the flow of a journey? Like, so there's, maybe 6 months where it's really tough and you had to take 2 jobs and stuff. Is that anything
No,
like that?
so last year, obviously, in the past couple of years, with the changes to the interest deductibility and whatnot, especially for people, I had people who bought the property after 27th March 2021, and it was not a new build, so they could not deduct interest cost at all. Because when the government changed the rules came retrospective. So we didn't know beforehand that that rule is coming. So people who had bought the property, not a new build, were not allowed to claim any interest. So obviously, you have made, let's say, $40,000, $30,000 interest cost, but you can't claim that as an expense, which means your property makes a profit, which means you got to pay tax on that profit. So those were the people who were really shortchanged and in trouble.
That's savage, eh? That's so they could have
So
they lost money
they
after interest
were
costs, and then
still
they had to
able
pay
to pay
tax
the
on profit.
tax. Yeah,
Huh?
they were still able to pay the taxes. It's not, they were not, but obviously they had to cut corners to pay the tax. Um, so yeah, the people have obviously had their share of loss.
Do you have like best practice on like you should keep this amount of money to cover 6 months of unexpected expenses, like, or using offset revolving, anything like people should
I
be
always
mindful of?
ask them to have, see, most of the people would not have, to be honest, Brian, most of the people would not have that kind of a cash flow to keep for 6 months, right? Especially if you are, if you've got a couple of mortgages. I do ask them to have a revolving credit always. Even if they have paid off their loan, have that money sitting in the revolving credit account so that tomorrow, if you want to dip into that money, you can, in case if something goes wrong. The other thing I say is, obviously, when the tax time comes, if you are unable to pay your tax, let me know straight away so that I can inform IRD. So we make sure that we don't get into trouble with IRD. That's the last thing you want, to be in trouble with IRD.